Hello innovators, and welcome to lesson 7 of the cryptocurrency course. Now this is one of my favorite lessons, and this is also one of the most heavily requested lessons that you guys have been asking for. Reason being is probably because I use it so much in my analytical outlooks, in my videos, and pretty much everywhere else. This is one of the staple tools that I feel every trader needs in their artillery when it comes to analysis, trading, investing, just generally all purposes of charting. I feel the Fibonacci tool is absolutely crucial to use. So in this lesson, we'll be going over certain principles that I like to call Fibception. Everyone who has been following me for a while will know the terminology of Fibception, using Fibonacci tools within Fibonacci tools from a top-down analysis perspective to gain an overall understanding of the next potential moves in the market. So starting off first and foremost, when you are on TradingView, if you go over to the left hand side and the tool panels over here, we have the crosshairs, we have the arrows and all of the other stuff over here, and then just below that we have a massive list of predominantly Fibonacci based tools. Now for this particular lesson we will be using the Fibonacci retracement, which no doubt you have seen in all of my videos. Now color preference wise, doesn't really matter too much how you do it. I can go to settings, and there are all kinds of different color alternatives and all kinds of different Fibonacci levels that can be used. However, general rule of thumb when it comes to the Fibonacci tool, as you can see here, by stretching out, yours will very likely look like this when you first open it. And these may not actually be here. It may be something a little bit different. I have so many different options. Let's go to the default. So when you first open this, your Fibonacci tool on TradingView will likely look like this, which is absolutely chaotic. It looks like some kind of fruit pastel, and it's not something we would necessarily want on our trading platform. The goal here is to keep the price action, the trading, the analysis as simplistic and as clean as possible. And quite frankly, this is not very clean. So we are going to go back to the tool we were just using, and we are going to set up, or I'm going to show you what color preferences I use, what retracements I use, and what extensions I use. Now before we get into that, let's just kind of break down what the Fibonacci purpose is. Now Fibonacci is essentially a self-fulfilling prophecy. It's a particular level in the market where price will pull back to, and when we say retracements, we basically mean pullbacks and corrections. A retracement, for example, would be something like this. So let's just say from A to B. I'm not sure why it's gone back to the defaults, but let's just get the innovation dark back up. Should be a bit different, but doesn't matter. There we go. So a retracement is basically a percentage of the movement from A to B of where price is likely going to pull back to the downside from or to the upside from. So when we're using the Fibonacci tool and we're talking in terms of retracements, we are talking about how deep of a pullback from A to B price will likely correct before continuing in the next potential direction. So in this particular example, if we were to mark out point A from the very low to the latest very high, so this is the swing low on the 4-hour time frame, something we've covered in prior lessons, and we have the swing high on the top. There are many different ways to do this, but for the first part of this lesson we're going to go over the basics. So this is the high, swing high. We will make that unbold and we will set that to the same color. That's the swing high over here. And then on the downside, we have the swing low. And we'll make that blue for the sake of this video. So down here, we have point A, point B. Now, what we are trying to do is, let's just say the overall momentum of the chart is bullish. That means we want to be looking ideally for long positions. By doing so, and the best way to do that, and the best way to identify probabilities of where price is likely going to go next, is by identifying the lowest low, which will be the swing low here, where we've seen a clear reversal from, and identifying the absolute swing high from the latest price action. So whilst this could be considered a swing high to many, if you actually put into consideration here where the real move has come into play to cause the bearish momentum, This was in fact just a very small pullback in comparison to the overall real high that's been formed over here. So whilst we easily could plot our Fibonacci from A to B over here, we're missing out on the overall bigger picture, which is very, very important. If I was to change this to a line tool as an example, you would see quite clearly that the real pullback from high, the absolute low, and the absolute high of this overall movement here would be there and there. So we want to be using the best probabilities possible in our favor and using the Fibonacci tool from the highest point and the lowest point. So for this particular example, again, do not use this as a real trade or anything, or consider it anything like that. We want to go from the low first, from A, B to the very high, and let's just say none of these settings were here. None of these extensions besides A and B. What we are doing is we are plotting how far price will pull back in terms of percentage from the lowest point to the highest point. Vice versa, if we'd done the same on the opposing side, we would be calculating how far back up price would be going from the highest point to the lowest point back up to the highest point. Judging from this information, we can then use what the Fibonacci tool presents us in an easily identifiable format to potentially gain a better understanding of where price may be heading next. Now, Fibonacci levels are not magical levels. They are not some kind of mysterious hocus pocus stuff. Quite frankly, when I say they're a self-fulfilling prophecy, it's no different to trend lines. It's no different to support and resistance, because every single trader out there is likely looking at the same stuff. It just creates more volatility in the market when they are fulfilled. So in simple terms, when someone sees, let's just say, a 50% retracement from high to low, all they are doing is potentially going to buy, because general trading practices and general education around the world has taught every single person that Fibonacci levels are key. So therefore, it creates more retail trader liquidity because they're likely to trade off these levels, which in return makes it a self-fulfilling prophecy. Now, let's just go back to what we're looking at here. So we are potentially projecting, not in this particular example, but let's just say we're looking for a movement higher on BTC. Depending on the overall trend, remember, you can't just go onto a 15-minute chart and start plotting random stuff. It has to be in line with the overall trend, something you will have discovered by the end of this video. But let's just say theoretically you were looking for a future potential target for BTC to go to. So you know you potentially want it to break out of this high and go higher. But before it continues higher, you want to identify where it will potentially come down to first from here, and then where it will potentially go to next. The easiest way to do this is with the Fibonacci tool, in line with everything else available on the chart. Now remember, no single tool is useful on its own, especially if you do not have a basic understanding of support and resistance, price action, and everything else that is required to understand price action trading and charting. This needs to be a staple part of your overall trading strategy, but it cannot be used alone. This is powerful when used in conjunction with trend lines, supports and resistance, and everything else I have taught you so far throughout the crypto course lessons, from trend identification to everything else moving forward. This is one of the most powerful tools, but it has to be used with additional confluences to make it as powerful as possible. So let's now go from the low to the high and identify what can be used. Now, traditional methods, you do not have to, again, these are all here just standards. There's so many different levels. The first thing you want to do as well, ideally, is get rid of the background. So when we add all of our retracement levels on here, you will see if you add a background, it pretty much highlights each individual segment between all of the retracement levels and the extensions. So what you want to be doing is getting rid of the background straight away. You do not want reverse ticked. That's not what you want to be doing. You want to have it on the correct side. So depending on the direction you draw it, it will give you a potential projection. Prices and levels, I personally have mine exactly like this. I like to see the prices on the right hand side and then correlate this with the additional technical analysis that I've done to aid my overall bias. Without the prices there, it just means I have to just quickly correlate it over there. But by having the prices labeled, it makes life a lot easier. And I always have them to the right, because no matter whether I'm bullish or bearish, they're closer to the overall prices on the axis on the right. Levels. We want to have labels to the right and labels to the middle. Again, you can put them a little bit on top, you can put them a little bit below, but quite frankly, I don't know why you would do that when you can put them precisely in line with the horizontal lines. And percentage wise as well, I like to have the percentages ticked versus the values. You can have 0.27 blah blah blah, but I like to know the overall percentage of that retracement to give me a bigger idea of how much better that move may be in the favor I'm looking for. Now, going back over to the upside, you can also incorporate a trend line into this, which conveniently just aligned with that, but we don't want to be using that trend line really. As effective as it may potentially be, it's not something I personally use. I mean, granted, it may actually work out in our favor, but it's best to keep it as simple as possible. And trend lines are not very necessary because we will have separate trend lines on our chart anyway when we're doing our analysis. You can also choose whether they're thicker, whether they're dotted, whether they're dashed. You can do all of this stuff. I used to use the dashed quite a lot just to kind of differentiate between the other levels. However, I personally don't really think this is too relevant, so I keep it nice and clean, nice levels over here. But again, if you want to just change it up a bit, by all means necessary, you can do so. Now, going over to these ones, you can fully extend these out, which isn't necessarily the worst thing in the world because it's a very good way. And something I always preach is how well do your Fibonacci retracement levels correlate with historical levels of price action. If you can see that these Fibonacci levels correlate precisely with historical data and price action, it increases the likelihood that these levels will be respected as some form of support and resistance. That is one of the best ways to do it. So instead of actually having this on permanently, it's always best to do it temporarily. And when you've plotted your levels, you can quickly tick these two to have a look at both the future price action and the prior historical price action, depending on where you're plotting these levels. One thing that you could do in terms of leaving it to the right before the price action commences is, let's just say you plotted these Fibonacci levels here at the point in time of the 23rd to the 24th of February. And if you left these levels on, you would see upon being broken, they came back to be respected as resistance. Then it came back to be support. Then it came back as support. Then it broke through and now it's technically resistance. So you can see how they clearly come back time and time again to repeat themselves. And that's not even including the 78.6 we added, which, as we can see quite clearly now, came back as a support level, was once a resistance here, then support, then resistance, then resistance, then support. When you actually leave these on, sometimes they can aid you in identifying what may potentially happen next. And this is something we'll be doing in a future lesson as well. But let's go back to the absolute basics. Now, the main levels you want to have, first and foremost, let's go back and stretch out the 4 hour. Let's go back to the high and low and plot these levels. Now, the first thing we want to be doing, the main generic levels and the traditional levels that you'll see many people using, is the 0.382, the 38.2% retracement, the 50% retracement, which of course, if we get rid of everything else, is quite simply a direct 50% pullback from the low to the high. Vice versa, if we were going from here to there, this would be directly 50% in between both of our levels. So as you can see, the 100% is our starting point, the 0 is the second point. So wherever we put the 100% point is our starting point. That is the 0. The secondary point is the 1. So whatever direction you start from, just as an example, let's close this. If we then flip the script and plot from high to low, we can see our starting point of the 100 is now from the top. So a very general rule of thumb here is when we are looking to sell, we plot from high to low. When we are looking for, and you can see a perfect 50% there. When we are looking to buy, we plot from the low to the high. As we can see, 50% broken, now retesting as resistance. That could potentially then lead to a future rollover. And you may notice, no matter how I draw this, it always ends up getting respected in one way or another. This 50% here from 4781 looks to be almost identical to the 50% retracement here. It pretty much is exactly the same level. That in itself is another correlation that this is a pretty solid level of resistance. And from an intraday perspective, this is how you can start to identify potential additional trades that you can quickly activate from these Fibonacci retracements in your favor. You will also notice, if I extended this to the left, how clean this price action actually is. If I went back to the 1 hour there, you can see this level was once support, it was once resistance, broke through, retested, perfect hold there on the support, going over, perfect resistance. It continuously repeats itself as a valid level. And again, it can aid your bias in identifying the best possibilities of what may happen next. But let's just go and get rid of this for now. And let's look at the overall levels that everyone traditionally uses. And then we're going to go over what I use myself personally for cryptocurrency purposes. Now, most people will generally use the first retracement level. So if we go from high to low, we are looking for pullbacks to the downside. That means anything from here, and I think the best thing we can do actually is go from here. So let's just say none of the price action has come through yet. And as a matter of fact, let's actually go from here where there was no reversal yet. So let's just say whilst price is pushing up, we are looking for a potential pullback in the market. So what that means is we are going to go from the absolute low, we'll go to the 4 hour for this, from the wick at the bottom to the high. In line with our other analysis, which you'll be able to figure out more and more over time, we are looking to potentially, let's just say, buy BTC from somewhere around here. But we need to wait for a potential pullback first. Or as a matter of fact, let's even do this from here. This will make life a lot easier for everyone. So let's just say we have seen the first reversal from this point in time. So let's just say we've been watching price action. It's been climbing, climbing, climbing. We drive up high and we see a massive slam down below. Now we can start anticipating there's potentially going to be a reversal on the cards. So from this point in time, where this 4 hour candle closes in this manner, respecting prior levels of support and resistance, we can anticipate that there's going to be some form of pullback somewhere around these levels before gearing up for the next potential move higher. Of course, in line with your overall analysis and trend, because the overall bullish at the moment, the overall trend is bullish, it puts the odds in our favor by first identifying Fibonacci's on the higher time frame and then dipping lower. But for this theoretical example, let's just ignore the trend, let's ignore any bias, let's ignore everything, and let's just focus on the tool itself. So you want to gain an understanding of a potential pullback in terms of percentage. How much of a percentage correction are we going to see from low to high to then give us a better understanding to dictate how much further this could potentially go? So the first thing we do is we'll go to the traditional methods, which are the 0.382, which is the 38.2% retracement. So that means from low to high, this would pull back 38.2% from the overall width of this support and resistance, and then potentially continue higher. We then have the 0.5%, which is of course the direct 50% center from this level to this level. These are very frequently found in Forex and can be found on more of the intraday levels on the BTC side and XRP and Ether side in particular, but they often do not come through as strongly in cryptocurrencies because prices are more frequently manipulated. We then have the 61.8% retracement. Again, a little bit lower than the 50%, but often great for a highly manipulative market like cryptocurrency, something we'll be getting into shortly. Then we have the 78.6%, which is one of my personal favorites and one of the levels that normally provides a greater opportunity for profitable trades to be executed. More importantly, you will notice the two I've had in many of my videos have a minus next to them. Now, these are the minus 27%, which actually goes above the high. And then we have the minus 61.8. My favorite level between the 78.6 and the 61.8 is also represented on the minus side. The 61.8% is frequently known as the golden ratio. If you understand the Fibonacci sequences, you will likely have heard of the 61.8% retracement. This is the golden ratio and something that everyone looks for when it comes to trading, which is why, if everyone is looking for it, I frequently prefer to go a step back, So whilst everyone executes or looks for trades or bounces from this level, it's likely they will be wiped out by the market makers at the next level down, sometimes even lower, before continuing in the direction. Now you will notice with these levels up above, I often refer to them as extensions. That's because once we see the pullback to one of these levels, let's just say from the 78.6, the general rule of thumb is the deeper a pullback occurs in the market, the higher the likelihood is that price will then continue in the direction towards these targets. Now there is a general rule of thumb for myself when it comes to cryptocurrencies, and this is very important to distinguish. This is not 100% accurate, and nothing in trading ever will be, no matter whether you do trend lines, whether you do support and resistance, Fibonacci or spirals, whatever you want to use, nothing will work 100% of the time. But the general rule of thumb I have identified myself is when we go to the 78.6% retracement, which I will mark in blue, we often see price go to the second extension of the minus 61.8. So that means from a trading perspective, if I was looking to buy from this level, I would then place my stop loss either below the prior low, depending on what the trade is, a swing trade. I may place it here, I may place it there. Regardless, let's just say the stop loss was here. I would then set my target automatically at this level, because I know because the pullback has exceeded a 50% and 61.8% retracement, the likelihood of extending way further higher is increasing, because as price goes lower, it's creating more liquidity for a major shift in the opposing direction of the retracement. However, if price only goes down to, let's just say, the 61.8% retracement, it's more likely than not going to go to the minus 27%. This is the general rule of thumb for the Fibonacci sequence, in particular on cryptocurrencies. However, with experimentation and backtesting, you will quickly be able to figure this out on the Forex side and stocks as well, or any other commodities you're looking at. Now, this doesn't mean that if it hits one of these levels, it cannot actually go to these extensions. However, the general rule of thumb is when it comes to risk to reward, you want to be looking at different levels. If you're entering from here, you would want your stop loss below the 78.6 if you're going to take that risk, and then you're going to have to focus more on the first target, which is the minus 27. However, if you're entering from here, and you know you can have a much wider stop loss because you've got one of the last retracement levels, you've not only increased your risk to reward massively to potentially make even 14% for the full swing trade, you are enabling yourself a much tighter stop loss as well. But what is also very important to notice is it doesn't rule out the fact that it could hit on the occasional movements, simply just coming down to the 38.2 as an example. Make that nice and light, and then pushing all the way to this extension as well. Because sometimes, and depending on how strong the trend is, the stronger the trend, and if the smaller level retracement levels are held, this simply means if we get rid of this and get rid of this, all that can mean is sometimes in the rare instances these Fibonacci retracements do work, like the 38.2 or even the 28.6 is one that many people use, but I prefer the 38.2 versus the 28.6. If you do see this come through, that can often mean the trend is so bullish in this particular example that it couldn't even find the momentum to pull back, and it just continues rallying even further to the second extension. So there can be that situation as well, but this also depends massively on the trend at hand. So if we were to go from here to here as an example on a more 1 hour or even an intraday perspective, if we were to have a little look at this, we can see here, and we're going to break this down now bit by bit. We go from A to B, so from the very high to the swing low, we tap into the 50%, just fell short, we drive down, we fulfill the Fibonacci target. Now, we need to understand the overall sequence. So what that means is from A to B to C, C being the extensions, we then move down to the D extension. So the C is the retracement, the D is the extension. We've now fulfilled the Fibonacci target. So what we then do is to continue the sequence. We go from where the 50% retracement was tapped, the C extension, the C retracement, sorry, and then we plot the next fib, continuing the sequence down to the D extension. Now what happens here next? We come from A to B. This time we go to the 78.6. And where do we go from there next? We drive down precisely into this minus 61.8% retracement, the extension, sorry, minus 61.8% precisely. How does it look before? You probably wouldn't have been able to figure that out too well without a Fibonacci sequence placed. So now we go back to the C retracement, which is where the 78.6 is. We continue the sequence once more. We then go lower, down to this level here. We go from A to B. We look up, it's rejected, it's rejected. We see a little false break of the 61.8. We just fall short of the 78.6 and boom, we drop again. We've now fulfilled a new sequence. We came in, we tapped, because remember we hit the 61.8. We drove directly down to the minus 27% retracement first because it's only hit the 61.8. However, with the lack of momentum driving higher, the B, so we've got the A and the B, from where that was once the support level, it broke through, came through as resistance. We then dumped down to the second level and broke this. So yet again, we continue the sequence until it begins to fail us. However, here's where things get interesting, because before we saw this coming through, you will notice that from A to B to C is pretty much precisely where the 50% retracement aligns with the prior Fibonacci B we had over here. So then we can see from A to B, we hit the 50%, which shows now the bearish momentum is getting so strong, we can't even pull back up to these regions and bang, straight down to the next extension. And in fact, when I say next extension, I mean the whole way down to the next extension. So then we have pretty much invalidated the overall Fibonacci sequence. So what we do from this point here is we plot this all the way down here. Now we can see from A to B, from the last real swing, if we put it from here, it doesn't work anymore. If we put it from there, it won't work because the low is from there. So if we go back to here, we go back up to here, we can see it isn't met. So if you go to the 1 hour, however, you can see it's broken through. You go to the 4 hour and things are a bit different. From A to B to C, we can see we didn't actually close on the 4 hour. And remember, the higher time frames are the most crucial when it comes to Fibonacci analysis and understanding. So if the 4 hour hasn't actually closed below, we've technically triggered the 78.6 and we've dumped lower. And where have we gone to? We've gone to here, the first extension. So we actually did fall short of this one this time. But then what we can do is extend this out, just leave it. As we can see, we broke because we haven't hit this level yet, and we still haven't hit this level yet. So this tells me, if we get rid of this right now, this tells me because this fib has hit the 78.6 and this hasn't been fulfilled yet, there is an increasingly larger possibility it will still come through to get fulfilled. Now what I've actually done here in this particular instance is not touched it. So we can get rid of the setup that we just had earlier. Let's just forget any of this for 1 second. And let's just leave these levels here. We can see we've driven higher, we precisely tapped the minus 27%. We've then come into the 38.2, the 50. It's come back down and hit the extension again. It's broken lower. We've come back up, we've pierced through, we've hit the 50. So there is still a possibility that if we now drag this to here, let's mark out this level first of all actually, at 41. Now we can drag this from high to low. We can now see A, B, C. We've hit the C extension. So what that means, C retracement, sorry. And then with the next movement lower, that will not only take us through to this level, but also a little bit lower. Then we confirm the new potential Fibonacci sequence. So if we just plot this from here, we go over to the pink to correlate with the 61.8% retracement. We can see overall, if you get too caught up in the movements, you may lose focus of the overall bigger picture. So what we're going to do is, I'm going to show you a bit of fibception. Anywhere from the monthly time frame to the weekly and daily are the strongest ways to find retracement levels. So why has this frozen? Is it because I'm on replay tool? Yes, it is. So if we go to the monthly now, we can see the larger the retracements come through, if it's on the monthly time frame, the stronger it will be in your favor. Now here is an interesting Fibonacci thing to show you. The first one is from the 2017 all-time high down to the low. We can see the extensions did not come through. However, the retracements themselves were absolutely flawless. Now this is important to understand with cryptocurrencies. When you are using the likes of the weekly or you are using the likes of the monthly, because the movement is so big, it's highly unlikely you're actually going to see the extensions get fulfilled, especially to the downside. We're obviously not going to see minus $1,367 on BTC. However, that doesn't mean these retracement levels will not come through. They will still work. However, what you need to understand is when there is an unrealistic extension level down below at the D extension, you do need to disregard that. But what you do not need to disregard is the power of the Fibonacci retracements themselves. So as we can see from 2017's all-time high, getting that as close as possible, we went from A to B to the C retracement. We drove through, we held this level, the 50% directly. However, we tapped into the 61.8. This is where a dangerously alarming possibility will then occur. The price is looking to reverse the whole way back down. Now, knowing that we're obviously not going to go minus, all you would do in this instance, let's just mark out the 61.8% here. We know a retracement is likely going to occur on the monthly. So this is why the overall bigger picture is so important. And this is how I predicted the major market reversal at this point in time in 2019. It was simple Fibonacci basics. And look at this going into the future of 2020, November. We actually broke through this same level. We then retested this same level and we rocketed straight to this level, breaking and pushing higher. Now, if we get rid of this Fibonacci, and we know we're obviously not going to go all the way down, all we then do is switch sequence from the monthly. So we now know the monthly is looking to reverse at this period of time. So we then get the Fibonacci up from top to bottom, and we start looking at the next levels. So we can then anticipate over the next few weeks or months, depending on how long this takes, which is how I easily predicted this crash down to this level, and which is why I actually bought in 2020. So when you saw how I bought 200,000 XRP when I put 30k into the market, this is pretty much exactly how I done it. And that is how I managed to buy and flip my money so quickly. Very simple Fibonacci tools. So all we would have known is now, okay, the overall trend at this point in time from this rejection is likely going to be bearish. So now you know the overall trend is potentially bearish. That's when you can start dropping down and getting ready to prepare for what may potentially be coming next. There were many different ways to identify this. I'm pretty sure, if I remember, there was one trend line that came through as well. There was a trend line at that point in time, I don't remember, but now let's just go back to the monthly. So now we know, bigger picture wise, it could take months for this to potentially come through. So if we press play, we can see over the span of a few months, this eventually went lower, 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 and lower to fulfill the next Fibonacci targets. And as a matter of fact, the spike went through the 78.6, but it didn't close below the 78.6, which kind of shows in itself that it was respected massively. Now look at how those levels held beautifully. We broke back above. Let's wait for it. And then as time played out again and again and again, I thought this would be a bit faster, but it doesn't matter. So let's just watch this. Retesting. Goodbye. So in a way, by simply using this longer term Fibonacci outlook, we could have predicted that something along the lines of this would be happening. And this was actually one of the reasons why I did actually short BTC at 16k. Because when the extension started coming through, I was like, I'll give it a go here and I'll have a few attempts here with 1% risk. Because the Fibonacci sequence was completed, I was anticipating from there to do the following. I was then going to go from around here to to the new sequence, and then I was going to short it down, catch the next move, and then ride it up to the next wave. However, as we can see right now, that most certainly has not been the case because we are going higher and higher and higher. But now, to put this in perspective for all of you who do not believe the possibilities that it can go down to anywhere below $10,000, just put this in perspective. Although the Fibonacci here, just to put this in perspective for everyone, this is why you cannot disclose, or I guess you could say discredit, the possibility of what price can do next. The Fibonacci extension was at $5,400, but price went quite a bit lower. I mean, it went to almost 3K, depending on the chart you used. Some went to 4K, some went to 3K, but it did go into the 3,000s. So when you go from high to low now, and understanding why, if Bitcoin does want to start seeing those golden potential moves higher, we need to look, actually first of all, we have gone higher. Let's go back. So we can see here where I actually plotted that, didn't come back down, but let's just draw this higher. So we can see BTC can still easily come back to the 78.6, or even here, this is why I've covered, we can still come back to 20K easily because that was prior resistance anyway. But just having a look from a bigger picture here, I wouldn't be surprised if BTC would become bearish very soon. We've got an extension up there that's precisely at that level. We've got 73 or so thousand up there. Because this is the bigger picture, people are very ignorant and stubborn. They kind of do not believe it's possible, but it absolutely is. And this could easily come all the way back down, as we can see, using the theory of correlating with prior price action. Let's extend these lines to the left. We can see we just fell short of prior support. Let's plot it up there. This was once resistance. We broke through. If we go to the weekly, we can see how well that was corresponding as well. We can see we're obviously quite bearish at the moment. This could easily come all the way back down to the 78.6, drop even lower towards 10K or so, because none of this has been retested. And then it can easily go up to $92,000. However, if you go to the log, you can see in theory, it's not that bad. It's really not that far away. And it's really not, again, it's done it many times over, as you can see. If we have a look at this overall movement, probably will not be the same size due to how much this has actually moved down. But even if we were to get this from there, we can see we have just engulfed all of that price action. So this is why people think, well, oh no, it can't do this before. But if you look at the size of the movement, that's irrelevant. We need to look at the percentage of the retracement. And that percentage retracement, as a good example, from pretty much here was almost 80% watching the whole movement overall. So when you put that in perspective in terms of retracements and stuff, we can see we'll have to even go lower, way lower for the overall movement. So temporarily we kind of broke through there. We were looking at 80% plus from the overall all-time high of 2017 down. So when you put into perspective the actual size of retracements, not the size of the price action, because obviously the higher it goes, the larger the candles are going to be on both sides of the coin. So it doesn't really matter how big the movement is. You don't want to believe the media when they say the biggest day ever for Bitcoin, it's the biggest crash ever. It doesn't matter because price is higher. So obviously the candles are going to be larger and the volume of those movements are going to be $5,000 to $10,000 in single candles because price is so high. What matters is the percentage, and price can easily correct this much, especially in cryptocurrencies. But let's just go back to the example, and first and foremost, let's just get rid of the 0.5 and 382. The way I see it is, by waiting, this is where patience comes into play as well. By waiting only for the 61.8% retracement or the 78.6, you may miss some opportunities. That is the brutal and harsh reality of waiting for those extensions. But the beauty is you are only entering the highest probability opportunities available to you in the market. This is where Fibception comes into play, because let's just say we go from the daily, from A to B. Now we can get rid of that extension. So we can see at present from A to B, we've got A, B, C retracement 61.8. Now that automatically, theoretically leads us towards the likes of $38,754. If we go to pink to highlight that, we can see this correlates quite nicely with a prior wick. We've got some price action over here, and we've got a support floor here before blowing up. So this at the moment theoretically looks good, because if we go to the overall trend at the moment, we are currently bearish on this time frame. We've got a high, we've got a lower high, we've got another lower high from that point there, and we've got lower lows, lower lows, lower lows. So falling down to this level would create a new lower low, which would then continue the sequence of being relatively bearish. Now, understanding this is important, because what can we do to then aid the potential bias of reaching this 38,754 level? This is on the daily. If we go to the weekly, we can see that is precisely the high, all-time high, to the low of the following weekly candle. Now we can see from a weekly perspective, even if we plotted it here, this is the perfect A, B, C, and D potential extension. Exactly where the last prior week's candle, or the couple weeks back candle, opened and rocketed, and exactly where the past few weeks of January they closed and reversed from. So this is a very strong level. Now we go down to the next time frame. Is there anything else we can potentially identify at the moment? No, because the weeklies have only just closed. So the daily is precisely in line with the weekly, which is what we need. So what we can then do is go down to the 4-hour time frame. We've fulfilled the first fib. That's all good. Now let's go to the current high of the reversal of this Fibonacci retracement to the current low until this potentially forms. Now remember, we haven't got absolute confirmation yet that this is going to hold, but I believe this will. So what we would do here is mark out this level and start to look at what could be happening next. Now we can start to anticipate that we may see another pullback towards this region in line with what we've seen already, in line with the overall bearish momentum, which would then take us down to the new low. So if I was to make this blue to correlate for blue, we can see this is a potential scenario right now. That would then come back down to test the support floor. And what would happen from then? Now let's just say theoretically, price drove up to this level, $51,300, and then crashed all the way down to $42,345. We will get the horizontal ray, just as an example. This will be the extension, and this will be the retracement. So we have got a Fibonacci already going on the daily. As we can see, we've got the A, B, C. We're looking for D down here. But what may happen before we get there? We go lower. Now there's a Fibonacci, as we can see from the daily, the bigger levels here. Now we've got the bearish Fibonacci set up, A, B, C, within the overall Fibonacci. How can we figure out what to do next? Well, here's what we do when we anticipate in advance first and foremost. So let's just say this exact sequence came through and price spikes down to here. What we can do in that particular instance is get rid of this, and let's just say this did come through. We would then start looking at what would happen if it did come through and hit this level. Then we would have a new high and a new low. So then we plot the Fibonacci tool again, and we understand it could possibly go from here up to here to the next extension, which happens to be pretty much in between both of these levels, which is our target around this price from the overall Fibonacci. Don't forget, because we've hit the what's it called, the 61.8 over here, it increases the likelihood of the first target coming through. So now you can see if the Fibonacci sequence comes through, the candle bodies could very easily come up to here, down to here, back up to here, and down to there. That then fulfills the sequence. It's absolutely beautiful. And what that could also mean in the process is, just because, let me just stop that for a second, just because this could potentially happen, what could be happening in this instance is we spike down to this level, but the candle bodies actually close at this level here. So we may see a spike down. I don't think I could illustrate it on this. We may see a spike down, wick fishing to the actual extensions over here, but we may in fact close exactly in line here with the larger daily Fibonacci sequence, if you get what I'm saying. That would then correlate a fib within a fib. But let's not confuse it too much. Let's look and go back to the general price action we were looking at. So this is the overall fib. Go back to the 4 hour. Plot this in here. Lovely. So we are looking at overall $50,222 or so to $51,300. Now we go down to the next time frame. Now we look. We go to the low, we go to the high. We go in the opposing direction, a Fibonacci within a Fibonacci. Now what do we have here? We have, even if I go to the 4 hour, you can see this. Now we have a realistic probability of how we're going to get to these levels. From A to B to C, we can see the C retracement has been broken. We have technically just fell short of the 78.6, which kind of still counts as a retracement for now. If we go to the extensions, we can see that the minus 27% correlates with our daily 61.8% retracement. So now our targets correlate with our extension levels. Then we have the minus 61.8, which correlates with our 78.6% retracement. We have two extensions aligning with our major daily retracement levels. So we now know there is a likelihood, as we're watching this, it will probably happen, I wouldn't be surprised, that BTC is going to rocket towards 50,300 up to 51,300 to 400 or so. Then we understand on the daily time frame, or even the 30-minute or 1 minute, we now know we need to fulfill these extensions, which will confirm this Fibonacci sequence, which will inevitably lead us, if I get rid of this, to our daily targets up above here, as you can see. Now, if we were to even get rid of these for 1 second, you could also potentially predict that this may happen. Price can tap from A, B, C here at the retracement, and look at where the extension aligns. If it is to pull back up, that happens to be exactly where the 78.6 is. So you're using inverse Fibonacci tools from both the bullish and bearish scenario to see how price can potentially get to the Fibonacci sequence that is in the overall momentum you have identified. So because we are looking at a relatively bearish scenario, we are looking at what Fibonacci sequences can potentially give us the additional bias to fulfill the retracement levels. So now we can see here, if I go to the daily and plot this out, A, B, C aligns with D. So we now know if this Fibonacci sequence is to come through, we are not only going to see the extension triggered, but if we go back to the daily, we then have the 78.6 triggered, which completes both an extension and a retracement in one single movement, which then increases the possibilities upon this happening of this movement then coming through all the way down to the next potential target down at this level, which I of course believe is unfolding very, very soon. And I think as March starts coming to an end, once we see these levels fulfilled, I believe there's now going to be a massive possibility that all of this is coming through. And quite frankly, this has only been done with just the Fibonacci tool. We can go, I can literally right now, as long as you understand the overall trend, we can probably go to the 5 minute and find some Fibonacci's. Let's just go anywhere. A, B, C, D. Simple. That's a trade right there. A, B, C, the extension fulfilled. That's a trade right there. The only problem is the market is obviously so choppy. We don't want to be doing this too much, but let's just say we have this one here. A, B, C, D. But of course, you can't just jump on the chart and do this out of nowhere. You do, of course, need to have other analysis in line with your analysis as well, such as support and resistance, such as a potential trend line, which we can see over here. Let's plot that out properly. Was then broken. What can we do to potentially identify that one? Going from the absolute high, or from this point here where the swing was. Let's just say from here to here, it wasn't met. Did it meet any of the others? Yes, it did. Hit the 38.2. Bang, comes down to the targets. But again, we want to try and stick to the best probabilities possible, because we know by using something like this, getting rid of this trend line and the support, we know if the 78.6 is hit, we're likely going to see the minus 61.8. So from a trading perspective, again, has to be used in line with all of your other analysis. We know if we executed here, even with a stop loss below this level and went up to this target, that's 5% made. With the extension, that's 7%. With a smaller stop loss below here, that could be anywhere from 11 to even 7.5 or 8%, just from these extensions being fulfilled. I absolutely love the Fibonacci tool for this reason. This is, even on the 1 minute, it's probably even more chaotic, but you could probably get some nice little scalps in here. I mean, look, bang, absolutely perfect, absolutely perfect. So if we were to go from a 1 minute perspective over here, stop loss below, plotted all the way down there, that's 5%. Put it below the high there, you've made almost 8%. And that is on a 1 minute time frame, which of course isn't necessarily something we want to be doing frequently, because you need to identify first, is this going to be in line with the overall trend? You can't just go onto the charts, plot a Fibonacci tool, as accurate as these look to be pretty much every time. Here, this one broke first, and if you're fixated on the 1 minute, you may not realize that on the 5 minute, it actually holds up pretty well. A, B, C, D extension tap precisely. It's a win-win situation. But that is pretty much it in a nutshell. In the next few lessons, we're going to start combining the Fibonacci tool with everything else that comes with it as well. We're going to start combining it with support and resistance, the other stuff I've shown you, some of the new things I've been experimenting with as well, but just testing this on all different pairs. I mean, as you guys know, I absolutely love the Fibonacci tool when it comes to cryptocurrencies as well. I mean, well, just in general, I mean, even XRP, A, B, C, D. Then it went to the next extension. Fast forward a bit more, the same levels have come through time and time again as support and resistance. Have an experiment with this tool. Use it to your advantage. Try them on different time frames. Try them in different areas. Just try and experiment with this tool. And more importantly, try to keep it, especially on the cryptocurrency side, try to stick to the 61.8 or the 78.6% retracements. They are the best ones for cryptocurrencies. In Forex, we can use the 50 and the 38.2 or anything else. But with cryptocurrencies, due to these huge wicks and volatility, you increase your likelihood of a better trading opportunity by going for the deepest extensions possible. If we can go for these kind of extensions, you're increasing the possibility that everyone loses hope. But there's Fibonacci there, and you can then catch a nice entry down. By utilizing this, by experimenting, by practicing, this is going to elevate your trading tenfold. And that's why I've been so excited to get this lesson done for you all. And more importantly, I hope this is really clarified. I know we only used BTC, but I really wanted to just break it down bit by bit, Fibonacci within Fibonacci. I mean, obviously you can't use like a 3 month or a 6 month or a 2 week, but even on a simple 30-minute time frame, there is so much that can be achieved with this simple tool. A, B, C. We didn't hit that extension yet above, but look at the precision on that minus 27%. Learn to identify. Again, this is where you have to watch everything I've already made for you guys. From lesson 1 to lesson 2 to lesson 3, lesson 4. Go back and watch everything again until it sinks in. Because when you can identify trends, when you can identify channels, when you can identify support and resistance, then when you combine the Fibonacci with this, you are going to become a weapon of mass destruction. So I hope this lesson, this tutorial, has been beneficial. I hope this has enlightened any of you who haven't really understood how to use it properly, how you can combine Fibception back and forth as well. But hopefully this lesson has found you well. Looking forward to doing the next ones and looking forward to more content moving forward. So have a great day, guys, and I'll see you in the next crypto course lesson.